We are going to talk about fiscal years versus calendar years in this video. The time period concept says that accounting information is reported at regular intervals. The basic accounting period is 1 year. Around 60% of large companies use the calendar year from January 1st through December 31st for their financial reporting. That's called a calendar year and a fiscal year. However, a fiscal year may end on a date other than December 31st. A fiscal year is still a year in length, but it can end on any date. Companies also prepare financial statements for interim periods of less than a year, maybe a month, a quarter, or semi-annually. Now for some examples of various fiscal year ends. At Kent State University, its fiscal year end is June 30th. Several universities use a similar year end because it marks the end of an academic year. Amazon's fiscal year end is December 31st, so it uses a calendar year end. Target's fiscal year end is on the Saturday nearest to January 31st. Many retailers will use a fiscal year end that allows for merchandise returns to be included in the same year as the related sales. Lowe's fiscal year ends on the Friday nearest to the end of January. Again, Lowe's is a retailer and may use the January year end to reflect seasonal returns before starting a new fiscal year. Apple's fiscal year is the 52 or 53 week period that ends on the last Saturday of September. You can see that fiscal year ends can be widely varied from one company to another company. Companies select their fiscal year when they initially form and usually do not change their fiscal year. If companies could change their fiscal year at will, then years would not be comparable and financial reporting would be almost unable to be compared from one length of time to another length of time. So we stick with the initial fiscal year we select. Okay, that's it. We're done. This video was created and narrated by Dr. Wendy Tietz. Have a great day.